This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everybody, welcome back to the Human Action Podcast. In this episode, I am going to do a deep dive into the Austrian approach to capital and interest theory, and in particular, I'm going to relate it to the mainstream neoclassical approach. Now, for those of you who have followed my work for a while, you might say, Bob, didn't you already do this? Yes and no. So I have definitely hit these areas before in previous podcast episodes and things I've written in various outlets. But what prompted me to come back and hit this again is, number one, we've got a different audience now than perhaps was the case 3 years ago. So it's fine to have repetition on these important matters. But also, I was recently interviewing one of my old professors from NYU, a great guy, Alberto Bazzin, very open-minded. He was a mathematical economist trained at Chicago. And we were just talking about the controversy that's raging lately, on Twitter at least, over the use of mathematics and economics. Okay, and I wasn't arguing with him. I was just letting him explain his perspective. And I made the point that on the one hand, I had sort of acknowledged to him that, yes, I would notice in my own work when I was doing my dissertation at NYU, and I was working on what's called the Austrian pure time preference theory of interest, that one of the points I was trying to make to the Austrian crowd was that the term time preference is used to mean different economic things in the literature, and it's the same words, and that it's important just to be clear about what do you mean by that term. And I said to Alberto, and it was very easy, I can explain it to you as a mainstream mathematical economist, the distinction. And I went ahead and said it in math terms, and he understood immediately, oh yeah, there's that thing or it's this thing. Both could plausibly be called time preference, but you got to stick with one meaning and, be consistent with it. You can't just flip back and forth mid-argument, okay? But then I said, now having, congratulated you guys, Alberto, for your precision and formalism, on the other hand, I have to say, what also became apparent to me while I'm doing my dissertation at NYU is that the mainstream economists are walking around thinking that interest is due to the marginal product of capital, just like they think that real wages are due to the marginal product of labor or are equal to it in monetary terms, and at least with competitive markets and so on, right? And I said, and that is a fundamental confusion in the Austrian tradition. And yet, it seems like it just pops out of a standard neoclassical model, like the kind that we learned as first-year grad students at NYU, where you have a production function that takes K and L, like capital and labor, as inputs, and out pops output, and then the representative household can divide the output into consumption or saving, and carry the saved goods forward one period, and then they get thrown in the production function again, and so on, rinse and repeat. And that in that kind of a model, if you ask, assuming competitive markets, blah, 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 what is the real return to labor? It's, you take the production function, you take the first derivative with respect to the labor input variable, and that's what the wage rate is in real terms. And the idea is, if output goes up a little bit, because you put in a little bit more labor into the machine, into the factory or whatever, the production function, and you put in one more labor hour and output goes up by 10 apples, well then in equilibrium in a competitive market, that worker needs to be paid 10 apples for that hour of labor. And so he gets his marginal product, okay? Now, the Austrians agree with that, and so do the mainstream economists in their mathematical model. Of course, the Austrians would have all kinds of quibbles and deeper objections to that model, but the economic intuition is the same. But that correspondence does not carry over to the determination of interest. And so, again, in a simple model like that, of the kind that first-year grad students, at least back when I went through it, I think probably still to this day, learn, is like the introduction, get you warmed up how to work with these models, is you say, okay, well, what's the real interest rate in equilibrium? Well, capital has to earn its marginal product. And so put in a little bit, dose more of capital into the production function. Output physically goes up a little bit. And then that increment, that's the return to capital. And so in equilibrium, the real interest return to capital, they have to earn that increment and output. And hence in equilibrium, that's what the real interest rate equals. Okay. And I want to say the Austrians are going to fall out of their chair and say, whoa, that's not right. And we're not just arguing about you can't collapse the economy into a simple mathematical model that takes two inputs and, that's crazy. But beyond all that, just the economics of it is wrong. Even the dimensions are wrong. Okay? And that's what I want to unpack. And I was telling Alberto this, and I said, but now the thing that was weird and what I struggled with when I was in grad school is when we were learning those models, we're doing problem sets and taking the first derivative and blah, 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 and doing all that, the math was correct, right? So in the world of the model, I understood why that's what the textbook said the return to the capitalist was going to be. And so it wasn't wrong. And yet that seemed to be directly at odds with what Eugen von Bombaverk, a second generation Austrian, after, Menger was the founder of the school in 1871, and then Bombaverk was in the next wave and, was a huge pioneer, everybody agrees, in capital interest theory. And one of his contributions was he wrote this critique of what he called the naive productivity theory of interest. And in that, Bombaverk shows when people are trying to understand what is the source of the interest income that capitalists earn in a market economy, a natural hypothesis is to say, oh, well, because capital is productive. You can make more stuff with capital goods than without. So that's how the capitalists earn an interest return. And Bombaverk showed that no, there's a fundamental confusion going on there. You're getting mixed up. That isn't a good explanation. Okay, so I'm going to come back, folks, and spell that out. Don't worry. In this episode, by the time you're done, if you invest your time listening to this, I will explain that clearly, and you'll totally get it. Okay, but take my word for it at the moment. Bombaverk is definitely right when you understand what he's saying, and he walks you through and shows the fact that a farmer can have a bigger harvest physically, that can get more bushels of wheat or ears of corn or whatever using a tractor than if he didn't have the tractor available, that the physical productivity of the tractor, its ability, technologically speaking, to augment the yield of his operations, that does not explain why a farmer who has a sum of money and buys a tractor then can use it, and over time, when he does the accounting or has his accountant do it, that he ends up with a bigger sum of money accruing from the purchase of the tractor. Right? That in a sense, he earned a return on the financial capital that he poured into the tractor, if you want to think of it like that. And Bombaverk showed, to explain that phenomenon, why is it that maybe he earned 5% a year, correctly considered, on his investment in the tractor in money terms, and you can make it real interest, like 5% real return if you account for, changing money prices over time for price inflation. You can do that too. But the point is, when you're trying to explain that phenomenon, why is it that in general in the market economy, capitalists who have a sum of money at the outset can buy things with them and invest their proceeds such that over time they tend to earn a net return on that. So they end up with more financial capital than they started out with, even accounting for rising prices. How do you explain that? And Bombaverk said to say that capital goods are physically productive is completely missing the point, that that's not an explanation at all. All right, again, we'll come back and explain that. All right, but just take my word for it. That's what he did. And so there I was at NYU, a grad student working on this dissertation focusing on Bombaverkian capital and interest theory, but then, trying to relate it to what I was learning in the mathematical mainstream curriculum. And I was like, what the heck is going on here? That the math of these, that I'm learning on the blackboard or whatever in class is correct. And yet that seemed to enshrine the naive productivity theory into the equations. They were clearly saying in equilibrium in our models, the capitalists who start out and have a bunch of capital and contribute it to the production process, how do we explain what the real return is percentage-wise? Like what fraction of their capital, how much does it grow, measured in terms of itself? So, there wasn't some just basic confusion about inflation or something. No, the real rate of interest in that model was directly equal to just looking at the physical production function and saying, if you do a slight increment, you add epsilon more capital physically into the production process, that boosts the physical output by a certain amount. And then that relationship, the magnitude of that, of the one increment to the other, then pins down what has to be the real rate of interest in equilibrium. And I was just staring at that, like, I don't remember how long it took me. Might be a better story if I did, but I don't remember. But then I had the eureka moment. And I see what's going on. It's because in those simple models that you learn as a first-year grad student, and I think probably still do, everybody would acknowledge, we know that in the real world things are way more complicated, but for simplicity's sake, for tractability, just to get get warmed up in how these things work, we'll start with a real simple case where assume there's just one production function, one type of labor, and we'll just call it L to just measure, or L with a subscript of T if you want to make it indexed by time, and K with the subscript of T and T plus 1, T plus 2, whatever. And so, we know in the real world there's all kinds of different types of capital goods, but here we're just going to be real simple. And I realized that apparently innocuous assumption for convenience was driving the whole result. Okay? And all the Bumbaver's critique of the naive productivity theory falls away. It's a moot point. He's worrying over something that in practice can't ever be, or can't have an implication, any significance, if you were in a world where there was just one type of good and that the capital good was the same thing as the consumption good. They were physically the same thing. For example, Irving Fisher, who was one of the giants in neoclassical interest theory, when he was in his original pioneering works trying to lay out this framework and get people to think through the issues, he would use simplistic examples, and one of them was like, imagine the only good are sheep. And so they are like the capital and the consumption good at the same time. That you got like a flock of 100 sheep, and you want to decide, how many do I want to consume? And if you don't, it's like, you're saving it, but you're also kind of investing it, because if you don't, touch them, you just let them graze and whatever, the 100 sheep, let's say, will physically turn into 110 sheep next year. All right, some will die and some will be born, but not net. Imagine there's an internal 10% biological growth rate. And so in that world, if sheep are the only good that exists in this economy, it would have to be the case that the real rate of interest is 10%. Right? If you were going to, to say, well, what do you mean real rate of interest? Well, the real part means we're not worried about money prices. We're worried about actual goods. And so what it means to say, what's the real rate of interest in that world? It's, well, if you had 10 sheep right now and you sold them to somebody and he was going to give you a claim for, you could redeem it 1 year from now to get a certain number of sheep, in equilibrium, his claim would have to say, I'll give you 11 sheep next year for an implicit 10% net return, given that, the sheep multiply the way I said. Okay. And if you just think through the logic of why would that be, because he wouldn't be able to promise you more, and he wouldn't promise you less, because you could just hold the sheep and they would physically multiply. Right. So that's kind of how it gets pinned down. All right. And so I made that point to Alberto more succinctly. I didn't take, looking at the clock here, it took me 13 minutes to get here. I made the point much more quickly than that. And I said, so you see, Alberto, and I did that in my dissertation. I did a model. I did exactly what you guys said, that the defenders of mathematical economics will say, we know there's unrealistic assumptions, but you know what? If you think that one of our unrealistic assumptions is driving the result, and that it's not just an innocuous thing done for convenience and tractability, but if you think the question we're trying to answer, that the answer popping out of our model is dependent upon an unrealistic simplifying assumption we made, then you should just go ahead and take our model and tweak that, make the assumption one that you think is more realistic and conforming with the real world. And then when you get a different answer popping out, you show us that. And if we agree with your logic and so forth, then yes, we will agree that you won. You showed us that our earlier model, which everybody agrees is wrong in a sense, it's not really simulating the world. There's all sorts of simplifying assumptions made. But if the conclusion we were drawing on the question of interest to us as analysts, as economists, if the answer popping out of our simple model and you get one that's more realistic and you get the different answer, and we agree with your argument and whatnot, then yep, we'll agree you're right and we should stop saying the first thing. And so I said to Alberto, that's what I did in my dissertation. After the verbal quoting from Mombaver and going through stuff in my critiques that I gave of Misesian approach to the pure time preference theory, that was in the earlier chapters, and I gave my own version of what I thought could replace it and be a more robust Austrian theory. But then I had a mathematical appendix where I showed I'm going to just add one good. I'm going to have a mathematical model just like they taught us at NYU, and I'm going to have a capital good and a consumption good. And then I'm going to, in that world, I derived what the equilibrium wage rate was, and it was, as it normally is, that you take the derivative of the production function with respect to labor, boom, real wage rate. But in that world, because the capital and consumption goods were distinct things physically, the real interest rate was a more complicated expression. That what you needed to include in the equation to say what it equals in equilibrium was not just, you take the derivative of the production function with respect to the capital, but you also had to worry about the market price of the capital good measured in the consumption good, right? So there's not money in this, it's all real, just to keep things simple and to make sure we're not getting misled by nominal inflation. Okay? And then when I wrote that equation out, I'm sitting there looking at it and I realized, if we just assume that the capital and consumption good are the same thing, and so that the market price of the capital good is always one, right? Because if they're the same thing, the price of something measured in terms of itself is always one for all time periods. And if you plug that in, my more complicated expression reduced to saying the real interest rate equals the marginal product of capital. And I was like, so I thought, it's kind of like analogous to special relativity, right? Einstein showing that, Newtonian mechanics is basically right at slow speeds, because I'm writing out as Einstein the more correct general formulation of things. But in my equations that are more complicated than the ones Newton did, if you assume that the velocities of all the items in question are relatively low compared to the speed of light, my system of equations approximates the old, simpler Newtonian ones. And so that's the sense in which Newton was basically right in the special scenario where things weren't traveling very fast relative to light. Okay. And so what I was showing is I came up with a more general expression of what the real interest rate equals in equilibrium. And I showed, in the special case where there's only one good, where the capital and consumption good are the same thing physically, my more complicated expression reduces down to interest equals the marginal product of capital. And so I thought, isn't this what I'm supposed to do? That you guys told us, if you think what we're saying is wrong with our real simple math models, then go do one that's more robust, that has a more realistic assumption. I think we can all agree it's more realistic to assume there are two goods rather than one good, right? And yet I'm saying that little shift. So I said that to him. Again, I said it much more succinctly. And Alberto's response was, if I understood what he was getting at, is like, yeah, we know that. But I mean, look, it's the same kind of thing. There's more than one type of labor, right? But in those simple workhorse models that you learn as a first-year grad student, we assume one type of labor. But everyone knows in the real world there's different skill levels and wage rates aren't. It's not just And so again, I think he's missing the point there. And I'm just picking on him just because I had the conversation with him. The whole reason I was talking to him is he was very open-minded. He would go to the Austrian colloquium and so forth back in NYU days. And so that's why I was trying to talk to him, because I thought, this guy might at least give us a shot. Whereas the other people would just say, get out of here, you Austrians, give me a break. Right? So what I want to unpack in the remainder of this episode is first review Bumbaver's critique of the naive productivity theory, but then just try to drive home why there still is a fundamental qualitative difference between those two situations. So yes, it is true that in a very simplistic mainstream math model where they say, like y equals f of k comma L, that, to say output is y is a function of the capital input and the labor input. There, it's assuming all the different types of labor in the economy are like one homogeneous number, that it makes sense to say how much labor went into the production function this period. And that's just some number. When in reality, if you were going to make it more realistic, of course you'd say, well, how many, man hours of skilled brain surgery went in, and how many man hours of unskilled construction work went in, and how many man hours of people harvesting fruit went in, and how many hours of people laying bricks went, that there's all sorts of different skill sets, and that even if you're doing it like physically, to just try to make it a mechanical engineering problem in terms of inputs mapping into outputs, still the thing going into the production function is not just some number measuring how much total labor. Like you'd have to, there's multiplicity of types of labor. But still, the basic economic intuition is still correct to say, how do you know, at least in a competitive market, how much the owner of labor hours who sells them on the marketplace, how much will he get paid for that contribution to output? It's like, at least in equilibrium, in a competitive market, you would think there'd be a tendency that he would get paid according to him putting in his labor hour. How much does total output go up? He gets wages that could go buy that in the marketplace, right? So he doesn't literally get paid in terms of apples, but he gets money. But the idea is he goes into the marketplace, and then the money he gets as wages could buy the amount of apples that his labor physically produces. Okay? And that's the idea. And so, yes, it's a simplification to keep the model tractable to assume, let's just say this is one type of labor and that we can summarize all of the labor input by just some number each period. Okay. But by making it more realistic and breaking up into different types of labor, the economic logic of how you would explain each type of wage rate to say, how much do brain surgeons get paid per hour or per year? How much do baseball players get paid? How much do bricklayers get paid? It would still be the same logic. You would just say each consider in isolation, how much do they contribute to the increment and output, and that's what they get paid. Okay? Whereas with capital, no, that's not what's going on, right? If you're trying to say, right now the real interest rate's 8%, why? It's not correct to say, because there was, 8,000 units of capital that went in the production function and that raised output by a certain amount. And then if you take the, 1 divided by, and you say, but there's more than one type of capital good. Okay. And then it's not that, for one thing, notice it's not that the interest rate is different on each capital good, right? That's not what's going on. Okay. And so very quickly you realize that, no. The analog of the real wage rate for capital goods, physical things, machinery, tools, whatnot, the analog of that is not the interest rate, it's the rental price or the rental rate of those particular goods, right? So you could say, yes, using, like if your carpet's all just wrecked, like somebody spills something really bad on your carpet and you tried spraying it with cleaner, that's not working. You can go to like a Home Depot or something and rent like a heavy duty carpet cleaner, not something that would ever make sense for you to have in your house that you own, but you can rent these really, heavy duty things that you come and, they really scrub and shampoo your carpet or whatever, then you bring it back. And so maybe maybe it's a daily rate. You got to pay whatever, $200 to rent the thing for a day. Okay. And so there, when you say what determines, how come that thing rents for $200 a day, whereas if you needed whatever, a hammer from somebody and you wanted to rent a hammer and that would only be $5 a day. Okay. Why? You say, oh, because the carpet cleaner is more productive. That using that for a day boosts revenues, or it, spares me something. I'm willing to pay $200 for that thing, whereas the hammer doesn't boost output as much. Okay. And so that explains the rental prices. Or like a farmer who, just like he wants to hire some extra hands to pick some more crops during the day, and he pays them accordingly. Likewise, if somebody is renting whatever, a tractor, how much would the farmer pay per day to rent the tractor? He can run those numbers. But again, that's not explaining what the percentage interest rate is. That's just showing what is the per unit time period of the monetary rental rate of that item. Okay. And so you realize, wait, something's screwy. There's something much deeper going on. Okay. So that's the issue. And that's what I want to resolve in the balance of time of this episode. So let me first just do a quick review. Well, for many of you, it'll be a review. Some will be fresh, of von Bavarich's critique of the naive productivity theory. All right. So again, what we're trying to explain when we explain the phenomenon of interest is, why is it that capitalists who have some purchasing power, some financial capital, some financial wherewithal, why is it that if they invest in various concrete items, that over time they seem to earn a net return? They not only get back their original investment, but a yield on top of that. How do we explain that as economists? Okay. And so, one obvious explanation is to say, well, because the capital goods are physically productive. You produce more with capital than without, so duh. And so von Bavarich said, no, that's not right. And specifically, he said, because the capital goods contribution to output, that explains why it has a purchase price. But the interest return, if it's positive, if the interest rate is positive, what you're trying to explain is, why is it that the original purchase price of that item is actually less than the long run flow of extra revenue you're going to get from owning it? Because that really explains the net return when you invest in something, right? If you have $100,000 and you buy a tractor, and what do you do? You make forecasts and say, oh yes, with the tractor, my harvest will be higher by this amount, over time. And then at some point that, the tractor's breaking down or whatever, and at some point I just scrap it. Okay, so over the lifetime, if I'm just looking ahead, let's say I make accurate forecasts, oh yeah, the amount of bushels I bring to market will be this much higher every year because I have that tractor assisting me, and then I can sell the extra bushels, make extra money. So you can, at time zero, look forward and compute and estimate how much more money you'll be bringing in over time. And so von Bavarich's point was, the only way you taking your $100,000 and buying the tractor and earning more over time is if the long run extra revenues you receive from owning that tractor are higher than $100,000. That's how you earn a return. And so another way of putting it is, that original purchase price is actually less than the contribution you expect that thing to make to your production process over time. That's what makes a net return possible. And so von Bavarich said, citing the productivity of the good is going the wrong way. We're trying to explain its apparent undervaluation. We're not trying to explain how come people value capital goods. We're trying to explain how come they don't seem to value them enough. If you know that if I have this tractor in my possession over 10 years, it's going to bring in an extra, at the end of it, $120,000. How come I'm not willing to pay $120,000 for it right now? I'm only willing to pay 100, let's say. And that's what explains the interest return. And so Bauer said clearly, when we're trying to explain the apparent discount on capital goods, why are you able to buy them for less than it seems like they're worth in some sense? Clearly to say, oh, because capital goods are productive, that doesn't make any sense, right? Okay, so the resolution that Bauer came up with is he said, oh, it's because we're ignoring the time element. It's if we naively think that. The fact that the tractor is going to yield extra bushels of wheat over time, that we can't treat, extra bushels of wheat harvested 10 years from now as the same thing economically as extra bushels of wheat today. And so like the financial capital that I'm using to buy the tractor today, I could go buy present bushels of wheat. But what the tractor is it's like a technological claim ticket on a flow of future bushels of wheat, some of which aren't going to accrue until many years in the future. And so if you just accept for the moment that present wheat is more valuable, should have a higher market price than bushels of wheat that won't be delivered until 10 years from now, well, then it all makes sense. That the present capitalized value of that future flow of bushels in today's prices does not equal the same as the same physical number of bushels of wheat available right now would. Okay? And so that's why, in a sense, you could, like getting 100 units of wheat today, like the purchasing power could entitle you to more than 100 bushels of wheat over time, measured in their money terms all along the way. Okay? So that's his solution. All right. And then he went on to explain, well, why should present goods be more valuable than future goods? And he went through all that. Okay. So let me now that I've, walked you through that so you can see, I hope that I did a good job persuading you, yes, to say, why is it that, the interest rate is 8%? Why? To say, because people can produce more with capital goods than without, that it's not just that that's wrong, like that's missing, it's like the wrong dimension. Okay. One thing, where's the percentage coming into play, right? So, and tractors, it's not that tractors make more tractors, right? So you see, when I was going back with that Irving Fisher example of 100 sheep, if we don't consume them, they just multiply biologically into 110 sheep next period. And and so that pins down the real rate of interest in that world has to be 10%. Do you see how seductive that is and slippery and misleading it is? Because there's a lot packed into that the consumption good we assume is sheep. And we also, and it's also the capital good, to keep things simple, and that the capital good creates more of itself, but it's also the measure of real purchasing power in this example where it's the only good, like, a basket of consumption goods. What could it be? Just sheep, because that's the only thing there is, right? So you see how all these different concepts all get squashed into the same thing. And it's like, 100 sheep turn into 110 sheep next year. Real rate of interest is 10%. If a capitalist has financial capital and he, has the ability right now to buy 100 sheep, he could lend that out at interest. And it's got to be the case that next period he gets paid back enough money to go buy 110 sheep. And that's all pinned down by the technological productivity of sheep production, right? You take 100 sheep, you put them in the production function, out pops 110 sheep next period. What could be simpler than that? And I'm saying that is extremely misleading because in general, capital goods don't make copies of themselves. They make other goods. And if we're picking the unit of measure in terms of just like, what do we mean by the real rate of interest? You got to have some like basket of consumption goods to say, if you make a loan over time, how much, how many units of that basket of consumption goods can you buy over time? That's to give operational meaning to the real rate of interest. That's an obvious candidate. Okay. And so like, if we want to say it's bushels of wheat and the tractor makes, contributes to them, the point is what Bavaric showed. The issue is not having, adding more tractors to my farming operation, does that boost how many bushels of wheat I harvest each year? The issue is, what is the initial purchase price of the tractors measured in bushels of wheat, and how does that relate to the increment? That's what would explain the real rate of interest if we're picking bushels of wheat as like the numeraire. Okay? All right. So let me now just flip and explain what I did in my appendix. Oh, and I forgot to say, the reason I realized I need to do this episode is because I said to Alberto, you know what, I'll try to send you something like to, where I spelled all this out. And I said to the listeners of that podcast when I did the intro and the outro, and I said, I'll go find something for those of you who want to go, read up on this. And I realized this isn't written anywhere in an accessible form. It's in the appendix to my dissertation. I had done a standalone article for the History of Economic Thought journal, but when I got to this, part that was my personal favorite, where I have this equation that shows the general expression, but then if you plug in that there's one good, it reduces to what the mainstream guys were saying. The referee said, "No, this is too much. Just forget it." I'd done earlier stuff about Bavaric, and then this was like the pièce de résistance, and the referee said, "No, you got too much here. Cut this part." And so I did. Get the thing published. Got to do what you got to do. But the point is, I realized, I really don't have this written anywhere except in at the end of this big dissertation. Then no one's going to slog through that, or some of you do, but I can't expect people to do that. So that's why I'm partly doing here, is I want to have it in one accessible place for people to see what I'm talking about. And again, this is partly for Austrian grad students. So in case you're losing your mind like I was, trying to reconcile two things that seem contradictory and yet you can't point out the specific fallacy. So there's that element, but also if you are talking to a mainstream colleague and they say, well, you do this verbal logic, you're walking around in a circle, you can give them this and show them what you're talking about. I think I made it crystal clear. Okay, so let's just work with a hypothetical example. Suppose we're talking about a net, right? Somebody, Robinson Crusoe on his island, he builds a net that allows him to catch more fish per unit of time than he could with his bare hands. All right, and let's just suppose that the net augments his productivity by 100 fish per unit of time. All right, it could be days, months, whatever, whatever. Okay, and suppose that the net is such that physically it's good for 10 uses, but then after you use it the 10th time, it just frays and you got to throw it out. Okay, so there is physical depreciation in that sense. It's equally serviceable for the first 10 times you use it. It gives you 100 extra fish than what you would have gotten with your bare hands. But then after you use it the 10th time, it tears and Crusoe just throws it out and it's useless. Okay? So now the question is, what if we're going to model this in a mainstream fashion and try to talk about the real interest rate, how do we do it? So let's just assume that the consumption good in this world are the fish, and that the only type of capital good is this net. Okay, so there's only two goods in his labor. All right, if you want to call that a good, you can, but he can't consume that or anything. Okay, and so let me now show you. You can go ahead and write out a bunch of equations and things, but the money line is, what flashed up on the screen. This was the equation 4 that I ended up deriving. And so the I there stands for the real interest rate. You might have expected it to be an R, but I didn't do that because earlier I had used that to be the rental rate of the capital. And again, that's part of the problem in this literature is people use R to mean interest rate, but also it could mean rental rate. In some models, it's better, like they do distinguish these things. But I'm saying in these workhorse introductory models where there's just one type of capital good and it's the same thing as the consumption good, they tend to be, they tend to use R, and that it embeds the confusion. So here I called it I, but this is the real rate of interest. Okay. So I'm saying at time T, the real interest rate is the derivative of the production function with respect to that first argument. That's what the F1 means. And that K is the capital input at time T. And then L is how much labor goes in at time T. And then, but that's not it. That's in the numerator. And then you subtract. And then what that pi stands for, the pi is saying that's the price of the capital good measured in consumption good. The first term there is at time T. And then you subtract away its value, its price at time T plus 1. And then you divide all of that by the original purchase price of the capital good. Okay, now, don't be intimidated here. Let me just give you a simple example. And so let's say that, let me just do the example. Let me just tell you, let's make it so that the interest rate, the real interest rate's 5%. Okay, so that means in fish, if Crusoe has 100 fish and Friday comes along and Crusoe says, hey, Friday, here, I'll lend you 100 fish. In equilibrium, Friday has to give him 105 fish next period. Okay, let's just say that that's what we want the answer to be. What ends up happening here, given the brute physical facts that I've outlined in this story, right, with the net and how it works? So effectively, when you're wanting to say, like, what's the initial purchase price of that net? Let's assume the way that it works is you use the net over the course of a period of time, and then at the end of that period, you get that yield of the 100 extra fish, right? So that's the way we're going to handle the time element here. So we're going to say, like, you buy the net at time 0, and then what that's doing is entitling you, as T turns into 1, you all of a sudden have that extra 100 fish now that you would have gotten over and above what you could catch with your bare hands. And so if you could catch 8 fish in the time interval with your bare hands, with the net, you can catch 108 fish. Okay, so the net is adding 100. It's the net, no pun intended, it's the net yield physically of that during that time period, the flow. So it's over and above what you could get with your bare hands. Okay. And then that happens for 10 periods in a row, and then the net is frayed and useless and you throw it out. So there's a sense in which it's like the net is a bond that just pays 100 fish starting at the end of the first period and then at the end of the second for 10 periods in a row. And so if we're going to discount that flow of future fish at a 5% discount rate, the present value of that, I'm rounding, is like 772. Okay, so that's the initial purchase price. To buy that net right now, a brand new net, Crusoe would have to hand over 772 fish that, he could have accumulated over. He's catching fish with his bare hands, salting them and saving them, building up this big stockpile. And then, some entrepreneur is going out and getting vines and making a net and selling them. And how much would Crusoe value that? Well, in equilibrium, its price is going to be 772 fish, the spot price of that net when it's brand new. Now, how does this work? So, Crusoe goes and gets harvests 100 extra fish compared to what he would have gotten with his bare hands. And so in that expression there, that equation 4, that first term is 100, right? It's saying, what is the increment that F1 means? You're just taking the derivative with respect to the first argument. So because you put in one net, output went up 100 fish. Okay, so that's what that part is. But then you're subtracting the change in the price of the capital good over the course of that period. So to fill that in, we need to know, during the course of the period, the market value of that net goes down, right? That when I buy the net, it's brand new. I use it once. Now, at the start of the next period, that net is no longer brand new. At that point now, it only is going to entitle me to 9 future bursts of 100 fish. And so if you then just view that as a bond, that's going to give you 100 fish, starting at the end of this period, and then for 9 total periods, discounting it at a 5% rate, I'm rounding, it's about 711 fish. Okay, so in this equation 4, you would say, the top left one is 100 fish minus, and then in parentheses there, it would be 772 minus 711, right? Because the original purchase price of the capital good was 772. It drops to 711, okay? And so if you go ahead and do that, you end up with 39 is the numerator, right? Because it dropped by 61, right? So the market price of the net dropped by 61 fish. So the yield, the net yield, no pun intended, of owning that capital good for that first period is not the full 100 fish, because that's partially offset by the drop in the market value of your capital good. So the 100 fish is what you got. Like if you had just rented out the net, you could have rented it out for 100 fish, but then the value of the net itself, the market value measured in terms of fish, dropped by 61. And so the net yield for that period was only the 39 fish, right? And they say, oh, so the interest rate's 39, what, 39%? 39, what, 100%? No, you got to divide by the original purchase price, right? Because it's the top thing is 39 fish. And so if the interest rate is a percentage, it's a rate, you need to divide by some number of fish, right? To get the units of fish to cancel out, because interest rates aren't fish. You can say, oh man, the Fed cut interest rates today down to 2 fish. What the heck are you talking about, right? Because I'm saying like a lot of the discourse over this, the units aren't even right. The dimensions aren't right. Okay. So if the top of this numerator, or the numerator in this expression is 39 fish, then you divide by that original purchase price, which in this example, we already said is 772 fish. And so then, 39 fish divided by 772 fish equals approximately 5%. It's like 5.05, but that's because I've been rounding. If I gave you the exact numbers, it would have been exactly 5%. Okay? So that's how that works in an example like this. So I'm just showing you, even though that equation that I flashed up there might initially have been intimidating, saying, I'm not going to get it. I'm saying when you see what it's saying, it's not hard and it makes intuitive sense. It's saying, yes, of course, the extra physical yield in the consumption good that the capital good provides you matters, but there's other things going on. It's more complicated if the capital good is a distinct thing, and hence you have to worry about its value measured in terms of that consumption good. So again, this is von Bavarich's critique of the naive productivity theory, and I'm putting it here in mathematical form in a good little neoclassical model with all the I's dotted and T's crossed. Okay, now let me just show you something before I move on to the punchline. Let me show you why the physical productivity of capital is not sufficient for a positive interest rate. I can use the same framework, and it's consistent with the real interest rate measured in fish being 0%. And what would that look like? You say, if the nets couldn't harvest more fish, well, yeah, that would work. But you know what? You don't need to invoke that. Even if we still stipulate that physically speaking, a guy can go make a net and sell it to Crusoe, and then Crusoe can get 100 extra fish per period for 10 periods, and then the net is useless physically, it wears away, and he just discards it. That is consistent with a world on this island, an economy on this island, where the real interest rate measured in fish is 0%. And how could that be? Well, when Crusoe goes to originally buy the net, its market price is 1,000 fish. And so he buys it, okay. He uses it. He gets 100 fish by the end of that period, over and above what he would have gotten with his bare hands. But then what is the market price now of the net going into the next period? It's dropped down to 900. And then in the next period, it's 800 and 700 and so on. Okay? And such by the end of it, he's just recovered his fish back. And so for each period, to use that equation, he would say, in the numerator, you've got the 100 fish that he gets, due to the productivity of the net physically, but then you subtract the change in the market price from one period to the next, which is also 100. And so that numerator is 0. In the first period, it's 0 divided by 1,000. And so the net interest rate is 0%, even though the net is still just as physically productive, entitles you to an extra flow of real fish as it was before. And again, you see the trick, if you will, or what's going on? It's that I can just determine, I can tell you, I can make that work if the rate of interest is 5%. I can make it worth a rate of interest 0%. And so what's pinning down the valuation of the net is knowing what is the intertemporal exchange rate of fish. That if I know that, oh yeah, people prefer present fish to future fish, then there's going to be a positive discount rate measured in fish, and that will make the original purchase price of the net measured in fish lower than what 1,000. And that's why originally in that first scenario, when Crusoe puts in 772 fish to buy that net, and we determined after that first period, he had earned a net return of 39 fish. Okay? So, that's his free and clear, in other words. He's still got his 772 fish of his original capital intact, and he could eat that extra 39 and not impair his capital. That's another way of putting it, right? That he starts out with the 772 fish that he needs to buy the net, and then in that first period, he would be allowed to eat 39. He couldn't eat 100, by the way. If he ate the full 100 extra that net yielded, he would be implicitly eating some of his capital. He'd be consuming capital. But he can eat 39, and then he still has the 772 rolling over, such that at the very end, when he does it and that net wears away, he's still got 772 fish that he can roll over and then buy a brand new net. And he can just keep doing that and just gets that constant flow. Okay? And so again, it would be tempting to say, geez, if he just scrimps and saves, and in the beginning when he doesn't have a net and has no savings and just lives below his means, he's catching 8 fish per period with his bare hands, but let's say he only consumes 7. And every period he socks away a fish and just lets that accumulate. And then eventually he gets up to 772. He's got to have good storage. I don't know how he's doing that on the island, but go with me on this one, folks. And then once he gets up to 772, he can go buy the net. And now forever on, he can get, 39 plus 8. 47 fish per period that he can consume forever and maintain that 772 of his capital intact. That he's getting the 8 implicitly from his labor, and the 39 is like interest earnings on his saved capital. It would be the way you would decompose it, like as an accountant or a macroeconomist looking at what are the returns to the factors in this economy. Okay? So it would be tempting to say, geez, how's he getting at the flow of 39? And there is a sense in which, yes, the physical productivity of the net allows for that, but you can see how when you want to understand why is the interest rate 5% and not 10 or not 2 or not 0, clearly the physical productivity of the net is not the explanation, because I can make the interest rate any of those numbers I just said and be consistent with the net having the same physical productivity that we stipulated. Okay. Now, finally, the great reveal, put that equation back up. What if we don't have an economy where the net and the fish are different physical things, and hence you have to have a price of the net measured and quoted in fish, which allows for all these complications? What if instead we're back in Fisher's world where it's just sheep and that's it? So in that world, we can still apply this, this equation's still true. It's just, here, the capital good and the consumption good are the same physical thing. Instead of it being a net and fish, it's just sheep. Instead of it being a net gives you more fish, it's sheep give you more sheep. And so, at any given time, what is the market price of a sheep measured in sheep? It's 1. Not because of any deep economic insight, just because it's the same thing. So, of course, 1 sheep has a value of 1 sheep, as opposed to a brand new net, being 772 or being 1,000 or whatever. Okay? And so in this equation, what happens if pi of t is always 1 for all t? Well, the denominator is just a 1, so that goes away. And then pi of t is 1, and pi of t plus 1 is 1. And so that top right, the pi t minus pi t plus 1, that's 1 minus 1, that's 0, and that goes away. Oh, and so that equation 4 reduces to if the capital good and the consumption good are the same physical thing so that the price of each is just 1 all the time. Oh, look at that. That more complicated expression reduces down to the interest rate, the real rate of interest equals the marginal product of capital, right? The derivative of the production function with respect to that first argument, which is K. Okay, so that's what I'm saying. I think a lot of mainstream economists are walking around believing that interest income is due to the physical productivity of capital in the same way that labor income, wage income is due to the physical productivity of labor. And as the Austrians have been saying since Bombawerk, no, that's a fundamental confusion. That's not what's going on. It's way more complicated than that. The productivity of physical capital goods explains their rental rate. It does not explain the ratio of their unit rental rate to their spot purchase price, which is kind of like what the, at least gross rate of interest is. Okay, I will wrap up there. I'll put a link if you really are an overachiever and want to check out the dissertation. I'll put a link in the show notes page. I'll also link to my other conversation with Alberto Bazzin, which is, was very interesting in many other respects, but I did want to flesh this particular thing out. And again, if you're an Austrian in a grad program somewhere and your head is swimming, I hope now I've shown you what's going on. Thanks for your attention, everybody. See you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.